Good morning, everyone. Welcome to this update for global stocks and commodities for the 15th of October. We had the strongest week of the year last week, or the week before, in America, and the rally remained solid through this week. We saw advances in just about every market around the world. So very impressive week, and good to see at a time when a lot of the commentators are trotting out all the old stuff for the 30th anniversary of the '87 crash, and people seem to be a lot more nervous. But frankly, there's no reason to be. So let's take a look at the action for last week. I just want to present some of the facts around what's going on around the world, and I think, if you're not closely following charts and market indices, you're perhaps not aware of just how strong the rallies are around the world. And also commodity prices are going pretty well, and they're tracking the real world demand and supply. And that's just the fact that we've got synchronized global world growth economically, and we've also got rising corporate profitability as well. So that's a pretty good recipe for markets to be able to continue what they're doing. The S&P only managed 4 points higher on the week, but look, it was such a huge week last week, you'd have to expect that couldn't be repeated. So it was a good solid week. The Nasdaq continues to lead the markets higher, so it's still moving very strongly. And we've seen Germany, France, UK all in strong uptrends. Germany at basically all-time highs. The Japanese index is absolutely soaring and has just broken out above a major top. The US dollar did fall back last week on expectations about whether the Fed may raise rates in December, and that was largely triggered by some weaker than expected inflation data. So let's take a look at some charts. We'll start with the S&P, and you can see a little bit of a gain. This is a weekly chart, so you can see just quite a good week last week, but then just fairly mild in the week just gone, just edged ahead a little bit more. But look, we're at 25.53 was the close, and if you go back a year or so, I don't think there would have been too many people on the planet that would have said that we could have got above 2,500 points during 2017. It just wasn't on anyone's radar. The Nasdaq, of course, has done extremely well. This is the ETF that tracks the Nasdaq index, the QQQ, and you can see it's just continuing to move higher and set new highs. So a solid week of gains. If we look at the small caps, we've also not lost anything there. The Russell 2000 just went sideways for the week, but it remains also at all-time highs and not showing any signs of increased volatility. And for those that do look studiously at charts, you'll know that any market top, the first sign of a significant change in character in the market and a market top is that you get an increase in volatility. We start to see much larger range candles to the downside. We get sudden sell-offs on elevated volume, and clearly we're just not seeing anything remotely like that at the moment. So it remains plain sailing for now. Let's look at the European indices as well. This is the French index. Now, not at all-time highs, so this is a peak in 2000. This is the peak in 2007, so it peaked out well before the rest of the world did. So that's where France is. But if you look at where they've come from, around 2,800 points in 2011, and we're now at 5,400 points. They've pretty much doubled in the last 6 years. So definitely a strong uptrend happening in France. Let's look at Germany. Germany at all-time highs. So it's been setting new records for some time. So the German DAX up around 13,000 points. So it's still going strongly and not showing any signs of waning. And finally, the UK index, the FTSE. So we've broken out of a very, very large base. So there was this huge zone of a range which went from around 7,000 points down to about 3,500, and that's been basically building now for 16 to 17 years. We broke out of it in December of last year, so this year has really been all positive territory for the UK stock exchange, despite all the dire predictions about what Brexit would mean for the UK economy. That seems to be reflecting a pretty healthy situation. So that's a bit of a run around the global stock indices. Let's just check on the US dollar. So big picture, you can see we've had a little bit of a rebound, but we haven't managed to set new short-term highs yet. Now a little bit of a pullback through the week. So this is sort of make or break for the US dollar, and that's really important for obviously other currencies, but also all the stock markets as well. So it's really hard at this stage to say where this is going to go. Is it going to continue down and link up with that declining trend line? So perhaps get down to around here somewhere, or is this just part of a stair-step recovery in the US dollar? And I think the answer to that is just absolutely being driven by the level of inflation in America and Fed policy that stems from that. Now, next, let's look at the Australian dollar just while I'm here. So that weakness in the US dollar caused the Aussie dollar, which got down to 77, and it rebounded almost to 79 to finish the week. So the Aussie dollar up 2 cents on the week. Let's look at the ASX 200. So a little bit of a breakout. So finally, some traction in Australia. But look, I'm not getting too excited about that. Yes, we broke a short-term downtrend line, but it's really hard to see where our banks and other major stocks are going to gain enough support to push up to new highs above 6,000 points. So the Aussie stocks up to 79, and the ASX 200 was up 104 points on the week. The small caps are still surging. It's the strongest part of the Australian market by an absolute country mile, and the small cap index was up 4% on the week. So as I've been saying all year, the only place to be in Australia is in well-selected small caps and small and mid-cap stocks, and that's pretty much it. Turning now to precious metals. Gold was up by $30 to $13.05. A part of that was currency, but part of it was just outright buying of gold in itself. So a lot about the lack of inflation and hence the rate rise was really pushing gold back up again. Interestingly, the holdings in GLD, which is the world's largest ETF, have remained steady at 853. So the longer term investors in the gold market have not departed with this recent weakness in gold. So that's held steady all through. And precious metal stocks, we're seeing just a small uptrend, but look, it's very minor. So let's look at those charts. We'll start first of all with gold on a daily basis. So you can see we finished the week really quite strongly. And since the turnaround, which occurred on the 6th of October, it was quite a strong week and finished right on the highs. So you'd have to say there is an upward bias there. Gold is a pretty frustrating entity, but if you go back to the start of the year, gold was trading at $1,200. And now we're trading at $1,300, and we've been as high as $1,355. So clearly an uptrend in gold, and that's what it looks like on a weekly chart. So we've broke this major declining trend line that came off the peak in gold in 2011. So we've broken above that. We've come back. We've retested it, which often happens, even though that line is declining. We've gone back, we've tested that, and now a very, very strong week. So I wouldn't write off the possibility that gold could move back up and create new highs above 1380 to 1400. But I'm certainly not jumping on that bandwagon yet. And one of the reasons is if you look at GDX, so this is the main gold stock index on a weekly chart, you can see there is a bit of an uptrend. But we've also got a bit of a triangle forming up there as well. So we haven't been able to go up and form new medium-term highs. Yes, we're forming higher lows, which is a positive sign, but until we can break out here above 25.50 and then get through these other couple of resistance levels at around 27.5 and then 32, then we're not really seeing a sustainable rally in gold stocks. And I think until we start to see some more positive action, GDX above 25.50, then I'm not really terribly interested in the precious metals market at this stage. Turning to other commodities, copper surged higher to 310, and that certainly is a reflection of the real world. The supply and demand situation for copper is getting stronger. It was looking pretty robust for 2018 and beyond anyway, but the equation is just getting stronger and stronger, and copper is reflecting that. Now, crude oil bounced back as well with a weakness in the dollar, back to 51.5. The stocks, energy stocks are pausing, so it was a slight retrace on the week, but they are looking better. They're holding their gains, which is a better sign. So certainly things looking up in that sector. There's the spot copper chart. Quite a surge last week in copper, so we're back almost to those medium to long-term highs, and that's the bounce in crude oil. So just to wrap it up, inevitably when markets are doing well, excuse me, and when individual stocks are doing well, traders and investors get nervous. They get tempted to want to sell and protect the profit that they've got. The problem with that is that you could sell way too early, because stocks that are in good, strong uptrends will tend to go a lot further for a lot longer than anyone possibly imagines. So you can leave an awful lot of profit on the table if you get tempted to sell too soon. Markets go through various phases after a major downturn like we had in 2008. They go through various emotional stages, and throughout this rally, it's been the most hated bull market in history. People haven't accepted it, they haven't believed it, and we're only now just starting to begrudgingly see some signs that that things are improving. People are prepared to acknowledge. The media is now prepared to acknowledge that things are improving. So we've got to go through that phase, and that phase may take 6 months or a year to develop into something a bit more positive. And then you go through the euphoric stage where people start to finally believe in the stock market, and they all start to jump in at the end. So we're not even close to that. And the way that human psychology works is that I believe we're at least a year, possibly two, away from reaching that sort of situation where people just throw caution to the wind and push the stock market up in some sort of parabolic fashion. And until we see that, then this bull market has got plenty of legs, because it's founded on good solid fundamentals, good solid global growth, and good solid rise in corporate earnings. So we've still got a long, long way to go. And the US market breadth remains very impressive. If you look at the Russell 2000, you look at the number of stocks that are trading above their 50-day moving average. Look at the stocks that are that are setting new 52-week highs. These indicators are all at historic highs. So this market is very solid. Portfolio analyst this week, for those who are members, and also for anyone that would like to partake of the free trial that's on offer. It's going to be a focus on material stocks this week for obvious reasons, and I've identified a couple of really enticing plays in the copper space. So that's portfolio analyst for this week. There's my contact details for anyone that wants to communicate with me, and I'll be back with you next weekend. Cheers.